Welcome everyone to the Trust the Plan podcast. I'm Nick.
And I'm Jim.
And Jim, this is not the Feel Good edition.
No.
Next week will be.
No.
I'm pretty sure it's going to be next week.
All right, good.
So, Jim, back to school time. I know that you had a milestone with your oldest, right?
Yeah, a little different back to school year this year. My oldest is off to college, so dropped her off at school a couple weeks ago, and yeah, a lot of change, a lot of adjusting for both her and us, but excited for her to have a good year with some new experiences.
Any tears from mom on the drop-off?
There was a few from both my daughter and mom, but we're hanging in there.
Excellent. So how is it having a family of four at home?
It's funny. I mean, it does change things a little bit, you know. It's just a little quieter, a little less activities to have to worry about doing or things scheduled, and one less person going, you know, 3 different ways. You know, that's what tends to be the case around our house.
So she's playing volleyball, right?
She is, yep.
When does the season start in college?
Man, I think their first game is probably towards the end of August.
Oh, really?
I don't have the schedule memorized yet, but yeah, they get, you know, they're on campus. They get a couple weeks of you know, just training, scrimmages, stuff like that, and then they jump into games. Actually, no, it's the first weekend in September. That's when it is.
Okay.
Yep.
I was thinking winter for some reason.
No, it's definitely a fall sport. So
Okay.
They'll be done starting now. Obviously, first games in September, and they'll wrap up in November.
Nice. So you'll be making a lot of long drives to Ohio.
I think we're going to be putting some miles on the car. Yeah.
Good thing you didn't get a lease.
That's true. That's a good topic for another day, right?
Yeah. You know, this is obviously we're recording this and it'll be released later, but today was Quinn's first day of school.
Okay.
For second grade.
Mm-hmm.
It's August 19th. Feels really early, man.
It does seem a little
really early. We got shortchanged.
Yeah.
Yeah, and Hunter went back in late July to prep for his senior year. And then now Jack is a freshman at Father Gabriel Richard. So he'll got a lot of transition happening this year.
No kidding. Big change for a lot of people.
Okay, so on to our topic. We're talking about the memory hole. Mm-hmm. What in the world are we talking about here?
This was an interesting piece we came across from one of our strategists, Athena. You know, we hear so much recently about the Magnificent Seven. So this is called the Magnificent Memory Hole, right? And it's talking about these Magnificent Seven. If you're not in Google, Amazon, Apple, Meta, Microsoft, NVIDIA, Tesla, you're missing out, right? It talks about how that's the mindset that people have right now, is that you're missing out. These stocks are up, you know, I think it's something crazy like 120 some percent or whatever over the last, you know, last year or so. But what this piece is mentioning is that it's pretty easy to only look at it through the good time periods and not the bad time periods. Because when we had a bad market, you know, think back to 2022, people don't think about it. They often forget, like these companies were down like 44%. They were down twice the S&P. So just, you know, it's common when you find companies that have really high upside, they can also have, you know, really high downside potential. And that's what this is talking about.
Yeah, so that's the risk reward trade-off.
Mm-hmm.
You know, a lot of reward comes with a lot of risk. And as you mentioned, in 22, the market was down, I think at the low point, it was down 27% or so, memory serves. By the way, we're not recommending any investments in this podcast. Mm-hmm. We're not recommending any stocks or any funds or anything. So it's just for commentary. But yeah, S&P down like 19, 20% in the calendar year. And according to this chart, I guess it was a little worse than 40% for the Mag 7. Yeah. So double the downside.
Yep, absolutely. I mean, obviously the chart is a pretty good visual, but it shows you just the amount of volatility that they took on. And when things get bad, things can look really bad for them. And I think that one of the things that this talks about is when you are at the lows that we saw in 2022, you know, to get to the highs where we are today, I mean, it took 22 months, almost 2 years. So, you know, like I said, when you're selective with your time periods, it's pretty easy to say, you know, look how good these ones are doing, but, you know, really needing to keep in mind the bigger picture.
And so they made it back by the end of 23. We can see here on this chart, and then in 24 now they're off to new highs. But the annualized IRR is 11.9% over this time frame, like 2.5 years, which is still really good, right? Pretty good.
Yeah.
But people are only looking at, from the bottom to the top, which obviously is much stronger than 11.9. But it's easy to slice and dice this number. We could also include 2021, where they had an excellent year as well, where they outperformed. So question is, right, when you have growth in the lead, can you stomach this drawdown? Because, we believe in stocks for the long term, and we believe that over time they will be a great investment for people compared to any other type of investment. But you have to be able to stomach these downturns. And that's what we talk about, diversification, and not, owning things besides technology, owning things that, small caps, mid caps, international, emerging markets, fixed income, real estate, private equity, private credit, commodities. And it just so happens that the Mag 7 has been the leader of all of those asset classes for the past, 10 years, I guess you could say. But, that will not always be the case. So we keep wondering when it will shift. And we did a podcast a couple months ago. I believe it was in June, when we saw a really interesting shift where small caps were up like 3.5%, and the Mag 7 was down 4% on the same day. That just never really happens very often, right? Because they've been leading so much. So are we seeing a turn? Perhaps. We don't know. But also, when you look at decades where the internet was languishing, like in the 2000s, right? Because the 90s run up, 2000s was just terrible for the NASDAQ and the technology stocks. Like a bunch of companies are still not back in 2024, 24 years later, like Cisco, Intel, and all those. So you're going to have decades where technology's in favor, decades where it's not. And we don't know what comes next.
Yeah. Yeah. And I think the other thing that the article made a point to mention is, if you look at like a long-term average, they said, long-term stock return is going to be in the neighborhood of 10%. And if you look at this chart and this amount of volatility to only do, almost just under 2% better, that's a good thing to think about. Going back to what you just mentioned, Nick, like, do I want to ride this roller coaster, or do I want to just be on the slow and steady?
I can also play devil's advocate and say, if we went through a terrible bear market and coming out, we're still averaging 12%, that would be a win.
Yeah, true.
Right?
Yeah.
Because if you go back to 2008 or 2001, that you could never say this, right? It took years and years to dig out. So this is a pretty quick recovery, more like a mild bear market. And if we go back 2 years, you can look up the historical podcasts, things that we think are important to talk about. We were talking about, we had these big charts that we were showing, like all these different data sets of when the market's down 20%, right? It's a bear market, but is it a bear market with a recession or without a recession? And the bear markets with a recession were much longer, much deeper, much more painful. The bear markets without recession, they're more mild, and that's what we've seen here. I mean, down 27%, peak to trough, is really painful. Don't get me wrong.
Yeah.
But that's much more mild compared to the last two bear markets that we saw, like 2008, 2001. So, in our professional career, it was the most mild one.
Yeah. Yeah. It's a good way to look at it.
And we've come out of it strong. Now there's, talk of recession again. But, it looks like GDP's hanging in there around 2%. And, the jobs numbers are getting worse, but they're still positive. So we'll have to see. My concern about all this is that the government spending is so high right now, right? We're having like 1.7 trillion deficits every year. So the government spending could be really propping up the economy. And the new jobs that come in every month, it's been like 70,000 jobs a month are government hires. The government is accelerating the size. And that scares me, because we had like 110,000 new jobs and 70,000 of them are government.
Yeah.
That's out of whack.
Yeah, it seems like it could be problematic down the road.
Yeah, and we got Elon out there saying he wants to join a future Trump administration and be like the efficiency czar. Like, well, I think he could do that.
It's hard to argue with the success he's had, right?
Right. He came into Twitter and like it's only like 15 to 25% of the headcount, and
they're better than ever.
Yeah. So interesting times. But Jim, thanks for sharing the memory hole. All right, the timing or the time frame that you're looking at can really change your perspective.
Yeah, and I think that's the takeaway for sure.
And if you would like to have us take a look at your portfolio for a second opinion or your financial plan for a second opinion, you can look us up at peakwm.com and schedule a second opinion online.